Imagine a storm building so quietly that most people still see blue skies until the winds start ripping roofs off. That's where the U.S. economy stands at the end of 2025. Markets are near historic highs, but the undercurrents are screaming crisis. Analysts are now pointing to alarm signals across stocks, jobs, credit, and debt that are louder than anything we saw before previous financial collapses. Right now, the unemployment rate has climbed to its highest level in 4 years, weakening the job market that has long been America's strongest defense against a recession. At the same time, major market indicators that once foreshadowed downturns in 1929 and 2008, from stretched market valuations to structural slowdown, are flashing warning signs again. Economists tracking the so-called everything bubble, where stocks, bonds, housing, and credit all look overextended, are increasingly worried that this isn't just another slowdown. They're saying this time the vulnerabilities are built into the system itself, not just a cyclical wobble. And here's the terrifying part that keeps investors awake at night. This isn't just a potential downturn. The foundations that supported recoveries after 1929 and 2008 are already weakened or exhausted, meaning the next break could be sharper, faster, and more widespread than anything modern America has ever seen. You might think we've heard warnings before, but we've never seen debt this pervasive and entrenched in the modern U.S. economy. Behind the glossy headlines about strong GDP growth, there's a quieter, far more ominous threat: household debt levels climbing to record highs while financial stress grips average Americans. According to the latest Federal Reserve Bank of New York data, total U.S. household debt has surged past $18.5 trillion, pushed up by mortgages, credit cards, student loans, and HELOCs, all rising together, a broad-based debt wave that shows no signs of receding. But here's the real warning signal. Delinquency rates, the percentage of borrowers falling behind, are increasing across multiple categories. Student loans and credit cards in particular are rising toward levels not seen in over a decade. This isn't normal borrowing. This is pressure mounting where it hurts most. Experts tracking consumer financial stress have also flagged a troubling trend. Credit burdens have become the new normal, not a temporary spike. For months now, stress indicators have stayed at record highs, a sign that Americans are not just borrowing more, but struggling to keep up with what they already owe. And this isn't isolated to one slice of society. This is systemic. People with steady incomes are being pulled into long-term borrowing just to cover essentials. When debt stops being a tool and becomes a trap, the economy doesn't just slow, it starts to weaken from the bottom up. This isn't just Wall Street chatter anymore. Ordinary people are beginning to feel the strain in their wallets, on their paychecks, and at their dinner tables. You don't need to be a banker to see it. Local economies are weakening, job listings are thinning, and consumers are borrowing more just to tread water. But the deeper worry isn't only the size of the debt. It's what happens when people can't keep up with payments. Delinquency rates, especially on credit cards, auto loans, and student loans, are rising toward levels not seen in years, pushing households closer to financial pressure points that reverberate through the wider economy. And it's showing up in real-world stress on jobs. Unemployment in the U.S. has risen to 4.6%, the highest in years, with fewer jobs being added each month and hiring slowing sharply. This isn't just a blip. It's a trend that reflects deeper pressure on the workforce and household finances. Even sectors once thought immune are slowing. Retail, services, and manufacturing activity are losing momentum, with companies freezing hiring or cutting staff as economic uncertainty spreads. Analysts warn that this weakening labor market is the kind that doesn't just slow economic growth, it feeds back into lower spending and higher defaults. The message is clear. Millions aren't just hearing about the crash, they're living it. And as these stress signals build beneath the surface, they're setting the stage for something far more intense than a typical recession. Let's talk about something every investor and everyday American feels, but many ignore. The markets are signaling stress long before mainstream headlines admit it. Right now, major stock indexes are sitting near record highs. But underneath that shiny surface, multiple warning flags are waving. Analysts are pointing out that the market's rise has been driven more by optimism about future growth dreams like artificial intelligence than by real grounded earnings and economic strength. That kind of optimism without fundamentals has been a hallmark right before past major downturns. More ominous still, technical analysts have identified patterns in the market that historically precede sharp corrections. These aren't random opinions, they're the same kinds of setups seen before past crashes. And it's not just about stocks. Economists and commentators are now sounding the alarm that investors have grown too complacent, pushing valuations to extremes while broader economic stress mounts beneath the surface. Across the country, everyday consumers and workers are noticing slowdowns too. Despite job gains in some sectors, the unemployment rate has climbed to its highest level in years, signaling that the labor market is weakening, a foundational crack beneath the economy. At the same time, analysts warn that the divide in wealth and opportunity in the U.S. economy, what some call a K-shaped recovery gap where gains go to some but pain lands on many, could intensify broader social and financial stress. These signals, stretched valuations, market complacency, rising joblessness, and widening economic insecurity, don't happen in isolation. They align with patterns that often precede deeper market and economic breakdowns, not just mild downturns. There's a bitter truth economists are quietly admitting: the U.S. economy isn't just weakening, it's structurally fragile. It's not simply a matter of slower growth. The system itself is increasingly vulnerable to even a small shock. And this is exactly the recipe that precedes deeper financial collapses. At the heart of this fragility is one idea most people don't want to hear: we are running on borrowed resilience. Corporate debt, government deficits, and household leverage have all soared to levels that would have been unthinkable a decade ago. Some analysts say this isn't normal borrowing, it's systemic overextension, where debt pressures now define how the economy functions. Wall Street no longer whispers about risk, it shouts about it. Global institutions like the IMF have warned that U.S. stock valuations are well above underlying fundamentals and ripe for a sharp correction. These warnings aren't fringe theories. They come from the organization charged with watching global financial stability. And it's not just theory. Recession probability models and economist surveys show that odds of an economic downturn have climbed significantly compared to earlier in 2024 and 2023. Even mainstream forecasts now put recession risk well above normal, meaning the market's calm surface hides real danger underneath. On top of that, stock market valuations have reached stretch levels rarely seen outside of bubble periods like 1929 or the dot-com era. When valuations sit at extreme pricing while debt levels rise, even mild negative news can trigger violent market reactions. This isn't balanced concern, it's systemic risk. When the economy's support structures rely on borrowed time and borrowed money at historic scale, it doesn't take much to push things from slowdown to collapse, and that's exactly the kind of vulnerability that makes this downturn potential far worse than a normal recession, and a real threat to broader financial stability. You don't need a Wall Street insider to see what's happening. The economic signals are right in the open, and they're trending in one direction: stress. Business activity is also losing momentum. In December 2025, key measures of economic growth, including manufacturing and services, dropped to their weakest levels in months, signaling that demand among companies and consumers alike is softening. Now let's talk risk probabilities, and they're not comforting. While some models suggest recession probabilities have come down slightly, many indicators still point to heightened danger. Economists' recession odds surveys show risks have risen significantly compared to earlier in the year, with trade policy uncertainty and slowing spending amplifying downside risks. Even official financial system monitors are warning of vulnerabilities. Recent Federal Reserve reports highlight that slowing global and domestic growth could weaken credit fundamentals, increase defaults, and stress financial institutions by reducing their ability to absorb losses. That means this isn't a typical slowdown caused by one sector or one bad quarter. It's a broader decline in fundamental economic activity. Job creation is fading, business growth is sputtering, and financial conditions are tightening all at the same time. And one more thing, despite these warning signs, investor sentiment remains strangely optimistic. Many fund managers are betting on a soft landing, a mild downturn rather than a hard break, even as underlying data shows real economic weakening. That gap between where confidence sits and where the fundamentals point is exactly the kind of disconnect that precedes major market stress. In short, the cracks in the economy are no longer subtle, they're measurable, and they're already affecting everyday Americans. Millions may not yet call this a crash, but the early tremors are unmistakable. We've talked about growing debt, weakening jobs, and stretched markets, but now let's look at the real-time warning signals flashing red right now. These aren't theoretical models from 10 years ago. These are today's risk indicators, and they're pointing towards something far more serious than a mild slowdown. First, stock market analysis. Multiple market strategists now say the major indexes are overvalued and vulnerable to sharp correction, driven more by momentum and rate cut hopes than by solid economic strength. Investors are essentially betting on sentiment instead of fundamentals, a scenario that often precedes big downturns. Next, complacency. Even in the public sphere, long-standing economic warnings are being dusted off. Analysts have explicitly compared the current phase to pre-crisis complacency seen in 1929 and 2008, warning that confidence may be the final layer hiding systemic weakness below. Every one of these signals, stretched valuations, optimistic markets, weakening labor conditions, aren't random. They're part of the same pattern seen before, past major economic breakdowns. Systemic vulnerability combined with growing stress in the real economy. When multiple risk indicators align like this, the chances of a mild slowdown fade and the risk of a more severe contraction rises dramatically. Up until now, we've laid out the signals: rising debt, weakening jobs, stretched markets, and structural risks beneath the surface. But what happens when all those pressures converge? That's where things stop being abstract and start becoming dangerously real. Right now, official financial stability reports warn that the U.S. economy is walking a tightrope built on elevated debt, fragile credit markets, and stubborn inflation pressures. The Federal Reserve has identified near-term risks that, if they materialize together, could push the system from slow growth into a wider breakdown. These include rising debt servicing costs, increased defaults, and lower credit availability, all of which weaken the financial system's ability to absorb shocks. Even more troubling, analysts point out that prolonged weakness in growth, especially if accompanied by higher real borrowing costs, could erode balance sheets across households, businesses, and even the government. That's not just economic jargon. It means everyday people and companies could struggle to refinance loans, pay expenses, or sustain operations, which in turn feeds back into lower spending and rising defaults. We're not talking about a slight pullback. Multiple indicators now point toward a significant slowdown or contraction as likely outcomes if the current trends persist. Some surveys show recession odds rising into the mid-30% range, far higher than typical economic cycles, with economists increasingly worried that inflation won't return to target levels until 2027, meaning the Fed will struggle to balance rate cuts and financial stability. At the same time, market risk measures like stock overvaluation and concentrated valuations in a handful of mega-cap tech firms are setting the stage for a sharp correction that could amplify economic stress if confidence suddenly shifts. Fund managers are unusually bullish right now, but that very complacency can be the kindling that allows a spark to become a blaze. And it's not just stocks. Global systemic risk surveys now rank market volatility, sudden financial dislocations, and monetary fiscal policy uncertainty among the top risks for 2026. That means this isn't just a U.S. problem. The entire global financial ecosystem is already on edge. When these forces align, debt pressures rising, markets stretched, credit tightening, and policy options constrained, what once might have been a recession can turn into something far more intense, a structural financial breakdown. Unlike normal cycles where a downturn eventually resolves, a breakdown is systemic, self-reinforcing, and slower to recover from. All the data, all the warnings, all the economic tremors we've walked through aren't abstract footnotes. They're signals of real pain ahead for millions of Americans. Economists' own surveys now show recession odds climbing sharply, with some putting the chance of a downturn over the next year near the highest levels in decades as confidence slides and risks build. Even the labor market, once the bedrock of a resilient post-pandemic economy, is showing cracks. Mixed job data that suggests businesses are slowing hiring while layoffs edge up. At the same time, markets are flashing conflicting signals. Fund managers are unusually bullish, yet financial conditions, including high valuations, stretched asset prices, and concentrated risk in tech and credit markets, look frighteningly fragile. And here's the key point that few media outlets will tell you in bold letters. This isn't just a normal recession risk. It's a structural vulnerability. Debt levels remain sky high, price pressures haven't gone away, and key economic indicators like consumer confidence, leading indexes, and credit spreads aren't pointing to strong growth anytime soon. What does this mean for everyday people? Jobs and paychecks could come under broader pressure as hiring slows and layoffs rise. Household budgets may tighten as inflationary costs stay elevated while incomes grow more slowly. Credit stress could intensify, meaning more debt defaults and higher borrowing costs for families and small businesses. Retirement accounts and investments could see sharper swings, especially if markets correct suddenly. Economic confidence, the invisible engine of growth, may erode, making spending and investment pull back even more. This isn't speculation. It's the culmination of real economic forces that are already in motion: slowing job growth, stretched markets, elevated debt, and rising recession odds. The financial stress many economists warned about isn't a distant what if. Some of it is already becoming reality. If the economy slides further into contraction, the impact won't just be on Wall Street or in economic charts. It will be felt in everyday lives: jobs at risk, savings eroding, and plans postponed. So ask yourself this: if millions are already feeling the early tremors, what happens when the quake finally hits? Because when theory turns into impact, the consequences stretch far beyond spreadsheets, into homes, communities, and futures across the country.